MoneyWise Wednesday. Hey guys.
We're back.
Hey.
We're back.
We are back. We need our own theme song, I think, by now.
Yeah, I agree.
Welcome back.
Yeah, or Envision's back. We're back again. No? Would that be like copyright stuff? No.
Yeah.
Herschel, where are you going?
They got no rhythm and they can't sing.
Oh my God. I think community outreach is our calling.
For yourself, Kelly Merck.
Okay, I got no rhythm and I can't sing. Cece looks at me and she'll go, "No, Grandma, stop."
All right. So, Herschel, you look like you want to say something. What do you?
No, I just want to say happy Wednesday. I'm back. I'm ready. I'm excited for this. I'm excited for this because I know this is probably one of the biggest journeys that anybody can take in their life. And for us to have the platform to educate those that are viewing and wanting to learn, this is incredible. You know, I shared this with you over probably the last couple of hours. Like, this is probably one of the most powerful sessions we're going to have for future usage of the home ownership process.
Yeah, this is really good. And we're like, you know, we're changing it up a little bit. We got some fun little backgrounds. These are not the actual houses that we live in, just in case any of you might have been wondering.
No,
but we figured, you know what? We have a lot of fun with the kids sessions. We have different backgrounds for the kids. We thought we'll play with the adults a little bit today too, let you guys have something different to look at. So we all kind of picked a fun image. I think the one Kelly has behind her, she actually took with her phone or camera, didn't you, Kelly? Or is that a downloaded one?
It is a downloaded.
Downloaded? Oh,
yeah.
You always have good actual pictures that you upload, so I always think it's one. I should have put the painted ladies behind me from San Francisco. I actually do have a picture that I took with my own from there, but this was a house that I kind of thought I'd like to live in one day. Kind of cute, little southern cottage looking house. So.
And this was the street that I want to buy the whole street. So that'll be mine one day.
That's your dream. There you go. You'd be like the best landlord ever.
Yeah, I would.
Oh, that's awesome. That would be a great investment. Okay, let's jump in today. Home ownership. Well, before we jump in, we gotta do a shout out to our winners. We had 2 winners from last week. Congratulations to our gift card winners, Angela Herndon and Kathleen Carter. Congratulations. We are super, super happy for you. We'll be sending your gift cards in the mail shortly. So Kelly, you're going to be really leading our home ownership discussion today. There's a lot of different subtopics within the topic of home ownership or, you know, mortgages. So today we're really just going to kind of talk about one angle of that. But who knows, maybe we'll have some other future detailed home ownership or the buying process, all of that sort of sessions in the future. So Kelly, where do you want to start today?
Okay, today we're going to start, well, first, I'm Kelly. Kelly Walter was just talking, and we also have Herschel joining us.
Well, I guess I just assume everyone knows us. I'm so sorry.
Hi guys, we're back again.
We're back.
It's week 7, so I'm like, hey, we're all BFFs.
We're family now, right?
You know us.
Yeah.
Yeah, but you're right. Kelly, thank you for that. I'm so sorry.
Okay. So today we're going to start out really simple. We're going to start out with considering home ownership. So this isn't for the person that's bought 2, 3, 4 houses. This is for the person that might be renting right now or living with family members, and they're thinking about what their next step is. Are they going to continue to rent? Are they going to buy? And if you choose the buying route, what does that look like? What do you have to do to be prepared, and what steps do you need to take to make that move? So that's where we're going to start with. And I just want to, so I introduced us, but I wanted to tell you a little bit about each one of us because we all have very different roles. But this is a very important topic for all of us. I think that it's probably one of the most important topics that we discuss. Herschel is a certified financial counselor for the credit union. So he gets to meet with people and help them get ready for this process. So he sits with them, he works on their budget, he makes sure that they're ready to go. So when they're ready to make that step, they're prepared for it. Kelly's old role before she came on board with the community development team was as a branch manager. So she worked with people when they were coming in to make that purchase. It was face-to-face, one-on-one. Mine was a totally different experience with the members because I worked on the backside where when members had difficulties and couldn't make their payments and things came up, I was the person that worked with them to help them fix the problem that they were in. So we've all got very different experiences with it, plus our own personal experiences, but it kind of makes for a great team.
I'd say so too.
Yeah.
Man, that was dynamic. Thank you
That
for
was
that,
great.
Kelly. I think
Thank
that
you.
brought it all together. That was like
Yeah.
beautiful, beautiful. Thank you.
So the first thing that we want to talk about is if you're ready to buy a house. So there's renting and there's purchasing, and you need to know if buying is the right step for you at the time. Okay, so pros and cons. We talked a little bit about the pros and cons of purchasing versus renting. So we're going to talk about the pros and cons of houses. So a home has long-term value. You need to make payments towards a home. You need to pay taxes on a home. And you can remodel your home any way you like. So it looks like those are all pretty cut and dry, but they're not. So a home has long-term value. The pro of that is the value in your house may go up over time. The con is that it may not. I know if anybody purchased a house or had a house back in 2008, 2009, we all saw the values go down. And that's something most of us hadn't seen in a while. So they did go back up and things normal or evened back out. But you do have those times where the value could go down. You need to make payments towards a house, and a portion of every payment goes towards principal, and it gets closer to owning a valuable asset. The con is that you may have to put down a large down payment up front, and there may be other home ownership costs, and we'll talk about that in a minute. You need to pay taxes on a home. So homeowners may be able to deduct the mortgage interest and property tax on their income return, but the con is that you still have to pay the property taxes. And you can remodel your home in any way you want, but you're responsible for those fees associated with it. They don't get done by somebody else, you pay for it. So Herschel, can you go over the common terms that we've talked about a little bit and that we're going to continue to talk about?
Yes, absolutely. So income is probably one of the bigger ones that a lot of us neglect to understand, that that's where a lot of your purchase power comes from whenever you're seeking a mortgage, right? It's all based on how much you can afford. And I think the three of us have said it a number of times. Stay within the boundaries of your income and your budget, and I promise you your own home ownership process will be so much more grand, right? Income history, you have to show proof of employment. Stability is everything. No one wants to offer a long-term contract with such high risk to someone that has job after job. They want to see stability. They want to see at least 2 years of income history as well to show that you're in it for the long haul, right? Debt to income ratio. Percentage of that measures how much a person's monthly income goes towards debt, right? So debt to income, that means how much is coming in versus what's going out. What are you liable for? What do you have to pay every time you get paid, right? Debt to income. Your credit score is also a factor. It is going to allow you to be provided an interest rate. The interest in turn means what you're paying back. So the higher the score, right, the lower the risk. So that means the lower the rate. That means the less you have to pay back. But if you're risky to that potential lender, your score is potentially lower. So that means the risk considered to loan monies to you is elevated at a higher rate because you are riskier of a borrower. Down payment means, again, Kelly summed it up so beautifully with our kids, skin in the game. What are you bringing in to show that you are in it for the long haul? What do you have to say that if you take a chance with me, I'm willing to put up some of my money as well? Skin in the game, better way to put it. Kelly, thank you for sharing that. Back over to you, Kelly.
Thanks, Herschel. So a lot of what Herschel just went over, we've talked about in the past couple weeks. And this is no different. So the 5 C's of credit is capacity. That means how much, Herschel says this the best, capacity equals usage. So how much capacity you have on your credit. So your present and future ability to meet your payment obligations. Capital is your assets. So it's your cash, your savings account, investments, property. If you have a house currently or an investment property that you have rented out, those are all considered capital. Collateral is property or assets offered to secure a loan. So let's say, I'm going to switch gears a little bit, but let's say your car is paid off and you want to get a new loan and they ask for collateral. You can use your car because it's a tangible object. You can use your car as collateral. If you have a piece of property that's paid off, you can use that as collateral on another purchase. Your character. your history of delivering on commitments. How well have you paid back on the loans you've taken out previously? And the conditions, the purpose of the loan, and any factors that might affect your ability to repay. So now let's talk about debt to income, because you'll hear that a lot when you're working on purchasing a house. Your debt to income is your total monthly expenses divided by your total monthly income. So what that means is, it doesn't really mean your total debts, it means your total debts that are reported to the credit bureau. So that means your student loan payments, your card payments, your credit card payments. If you currently have a mortgage, those things are considered part of your monthly expenses. And then your monthly income is your income before all your deductions. So it's the big amount before they take out all that other stuff and leave you with that little amount. So that's what we're using for this. And Kelly, can you tell us what the threshold is usually for a mortgage purchase, what the DTI threshold is?
Yeah, so the rule of thumb in the mortgage world is 43% or less is favorable. So what that means is if you have over 43% debt to income ratio, you look more risky and it may be more difficult for you to get approval. Doesn't necessarily mean that you won't get approval. It just means that, you know, the lender knows that you may have, you know, you may have some struggles paying your payment in the event of an emergency.
So home buying cost, here we go. So when you're considering purchasing a house, there's costs that you have to consider. And they can be pretty pricey. So let's just kind of dive right in. There's the down payment. And the down payment can be anywhere from 3% to 20%. There's miscellaneous costs, and we'll go into those in just a minute. And then there's closing costs. So home buying costs, the miscellaneous costs. So we know we have to put a down payment down. Everybody's heard about down payments and everybody's heard about closing costs. But there's the miscellaneous costs. So there's a credit check. And some of these aren't really expensive, but it all adds up. So a credit check is less than $100. Inspection cost. You don't have to have your home inspected, but I would never buy a house without having it inspected. Would either of you?
No.
And the reason for that is that
It protects you.
Yeah, you just don't know. A house, even a brand new house, needs to be inspected because you weren't the one that built it. You don't know what happened to it. It's between 400 and 600, maybe a little more depending on the size of the house, but they will, if you get a reputable company, they will come in and they will show you every single thing that's wrong with that house. And then you've made an informed decision on whether you want to purchase that house or not.
Kelly, can I ask you a question? So you said inspections are not required.
They aren't.
Some lenders that can require that?
Yes. So there are, I know with like a lot of the first time home buyer programs, and I think that they do this because they want to protect their consumer, their person. They require it. There's some that don't require it. So you have to check with your lender. A lot of them do require it. Even if they don't require it, you should still do it.
Absolutely.
And if you decide not to buy that house based on the inspection, you're out that money, but you've really saved yourself a lot in the long run. And then there's appraisal costs. Appraisal costs are the costs, the appraiser will come out and verify that the house that you're purchasing is worth what you're offering. A lot of banks and lenders will not lend the amount over the appraised amount. So if you really want to buy that house, if you're offering somebody $300,000 for the house, but it's only worth $250,000, the bank may say, okay, we'll do this loan, but we'll only do it for $250,000. So again, that's an educated decision that you're going to make. Are you going to pay more than this house is worth? And that's where the appraisal costs come in. And then earnest money is your down payment. Earnest money is not your down payment.
Earnest money is to secure the contract,
right.
So it doesn't move to a different seller, buyer.
And then we'll talk about earnest money. Earnest money is the money that you're going to offer when you put your offer in on the house. So you're interested in a house, you find something, you talk to your realtor, and you want to put an offer in on a property. Along with that offer, you have to put up some money, and that will go towards your closing costs, towards the whole number. And if they don't accept it, you'll get that money back. But earnest money is kind of a security for the buyer, because what you're doing is you're making an offer and you're telling the seller that you want to buy the house, and here we want you to take it off the market. So in response to that, you have to put some money down. So there's, again, that skin in the game. You want to make sure that you have a little skin in the game.
It's kind of like a security deposit, right, Kelly?
Exactly.
Like a good faith security deposit to say, I'm good for this. I really want this place. I'm going to give you this deposit to hold that for me while all these other important checks are being done, pending approval on those things.
Absolutely. And earnest money, there's not a set dollar amount for it, but if you have really good credit and you're pre-approved and they see that you're serious and that you've got the down payment and everything, that you're all lined up, they may be okay with $1,000 or $2,000. But if your credit's kind of borderline and you have to sell a house or something, they may ask for more money than that. So just because you're offering $500 or $1,000, they may say, okay, we'll take this contract, but we want you to put more money up. So just be prepared. Things like that happen all the time. And then along with the inspection costs are the repair costs. So some of the things you can negotiate in the selling price of the house. You can get that taken care of before, like if it needs a new roof or something like that. But just because it's in the inspection doesn't mean they have to repair it. There's a percentage of wood rot that needs to be repaired. There's some things that have to be done before they can sell the house. And then there's other things that you're going to come up with afterwards that you're going to have to cover the cost of. And I will tell you, we've bought 3 houses, and 2 of the houses we bought within 6 months of buying the house, we had to replace air conditioners. That's a lot of money. I don't care if it's a 1,500 square foot house or if it's a 2,500 square foot house or bigger. It's a huge expense, and you've just spent all your money on the house. So just be prepared for any kind of repair costs. And then ongoing costs. So you've got all types of ongoing costs. You've got repairs, you've got maintenance, lawn care. If you have somebody that you pay to come out and do your lawn, you have to pay them. Otherwise, you have to get a mower if you didn't have a mower, and an edger, and and just all those things, they just add up. And homeowners fees. You check with the property that you're purchasing and make sure that if there is a homeowners association, how much are the fees and when are they due? If you're buying a condo, make sure you know what the condo fees are, and make sure you know what the amenities are that come along with it, because condo fees are a whole different game. It can be hundreds of dollars a month for condo fees. And then closing costs. Closing costs are expensive over and above the purchase price of the home. Closing costs include, but are not limited to, appraisal fees, tax service provider fees, title insurance, taxes, and prepaid expenses like property tax, homeowners insurance, and interest until your first payment is due. That's a whole lot of stuff, and it blows your mind if you haven't done it before. It kind of blows your mind if you have done it before. Your closing agent will put all that together for you. You'll know what all these fees are before you close, but just know that the closing costs are between 2 and 5% of the purchase price. I reached out to our mortgage department prepping for this, and our closing costs tend to be between 3 and 4%. And just so you know, you can ask the seller to pay up to 3% of your closing cost. But usually what will happen is they'll work it back into the price of the house. So if they're asking $210 for the house and your closing costs are $5,000, they may say, okay, but we're going to make the price of the house $215 to cover those closing costs, unless they're willing to come off the house price that much. So between 2 and 5% is what you'll need for closing costs, unless you can negotiate with the seller a little bit.
So let's talk about this for just a second, because
Sure.
you piqued my interest. And, so Herschel, when you are doing counseling with members and that you're helping them prepare for home ownership, it sounds like if you're planning on purchasing a home and you're going to have to put down money up front, knowing this 2 to 5% range can really help you come up with an actual hard dollar amount for you to consider when you're saving, considering when is the right time to buy, or should I buy, and can I afford that in my budget, right? Because people don't think that. They think, oh, I have the American dream of wanting to own a home, so I'm going to go get pre-approved, and then they get pre-approved, but then maybe they don't get pre-approved because they don't have the money to cover the closing costs, and that's their hurdle.
Yes.
Would you say, Herschel, that that's probably the first hurdle that people have, is that they don't have the cash flow to help cover that closing cost?
I would, Kelly. I'd say probably the first exchange of dialogue whenever the conversation opens up for them to take advantage of the services that we offer, more specifically the ones that I offer for the counseling piece, is we effectively move immediately into structuring a budget. I want to see what's coming in and what's going out, right? The dream is a dream, but it's only reality if we can make it come together on paper. So that budget is completely fulfilled, right? And then from that budget, I look to see how much more they're spending on things that could be reduced, right? And then from there, we start looking at potential debt consolidations to even put those revolving trade lines that they once had into a fixed rate type of product, so that now we can maximize their saving, so that we can go ahead and accomplish that 2 to 3 to 4 to 5% down payment that may be present at the time of ownership,
right?
Of approval, if you will.
And then it sounds like at the same time, however long that might take, 6 months, 12 months, hopefully their score's getting higher.
Absolutely.
You get pre-approved, they get the lower rate.
Great, right? To make sure that we're suppressing that monthly payment, to make sure that we're able to save for some of the challenges that Kelly brought up during her presentation. Maintenance, right? That's the first thing about home ownership, is that now you're the maintenance guy. It's no longer a landlord. Those filters that he once came in to change to protect the AC units that he has on all of his apartments, that's no longer his responsibility. It's yours. That's your AC unit. That's your filters that you have to replace monthly, right? Those are things that home ownership brings about that a lot of home owners aren't really ready or even expecting, right? But here we are.
Yeah. So, I wanted us to kind of talk about that for a second, because for those of you who are watching this going, I just want to own a home so badly. Do you want to own it badly enough that it puts you in a major financial pinch to scrape up everything that you have to your name to put down on closing costs, and then leaves you in a position where you cannot maintain, the home after purchase? Or the other part of it is, being that, I guess, that voice of hope for you, but going, it's not a matter of, like, we believe that you will have home ownership. Like, we all three believe that you will have home ownership. What we want you to really consider is the when. When will you have the home ownership? And it's okay to wait 6 months, 12 months, gosh, maybe even 2 or 3 years. So you can get all these other things in order. When you get there to home ownership, it's smoother. Yes. It's a hole in one, right?
Yes, man. I'm telling you, Kelly. Thank you for slowing this, Kelly. And Kelly, this is why I was excited about this, right? This is why I was excited. You guys know my passion behind delivering this to create that pathway and journey for home ownership, being a part of that process. One beautiful thing that I'd really love to add, really honestly, is, and this is not brand recognition, this is not brand awareness, this is me telling you exactly what I see every single day working for this organization. Envision is not going to just give money or not give money, or say yes or not say no, without the education piece that comes along with it, right? So right now, just out of my own personal testimony, I'm working with over 4 different members right now in the home buying process that were referred to me through our mortgage lending team, because they didn't quite meet the credit piece to be pre-approved. Do you see how powerful that is? We could have easily said, no, I'm sorry, you're not prepared for home ownership. But we took it one step further, and we said, let us help you begin this journey the right way. And then we're going to hold your hand throughout this entire home ownership process, up to and including potential referrals from realtors that we have a great rapport with, that holds an integrity stake in the community, that we know is going to take good care of you guys. This is powerful stuff. This is powerful stuff. It just warms my heart. I'm sorry. I digress.
And Herschel, I'm glad that you shared that, because one thing that we haven't really touched on in this conversation is reputable realtors and reputable people, and following along with somebody that has your best interest at heart, because you may get approved for $300,000 based on your DTI.
Here we go.
But if you know that you can't afford a payment for a $300,000 house, because it's not just principal and interest, it's taxes and insurance too. If you know in your heart that you can't afford that, don't spend that, because you don't want, and you'll meet people along the way that'll be like, well, you can get this house. We can put you in this mortgage, and you know, the interest rate will be lower for the first couple of years, and yeah, you'll be fine. Don't fall for that. Use your budget that you've worked on, know what your credit score is, know all the information that you have going in, and then start with that smaller house, start with that condo or whatever it is. You don't have to have your dream house first off. You know, that's, I think a lot of people that I worked with in the 12 years that I was in the other department were people that were in over their head, and a lot of them knew right from the start that they probably didn't need to buy that house, but it just looked so good and somebody told them that they could get it. You know, you're approved for this. You know what you're approved for. You know what you can handle payment wise, because you're making educated choices by doing your budget and checking your credit score, and don't fall for that, and don't look at houses that you know you can't afford. There's nothing worse than going and looking at a $500,000 house when you can afford a 200, because you won't want to see that $200,000 house at all. You know, so.
Kelly said it well too. Kelly said it well too during the kids version. Be honest with yourself. Okay. Now is the time to be honest with yourself and your budget, right? Be honest.
Yep.
Back to you, Kelly.
True.
So the next thing we're going to talk about is private mortgage insurance. And this is different than your regular insurance on your property. So Kelly, can you share a little bit about private mortgage insurance with us?
Yeah, absolutely. So basically what PMI is, it's an insurance that guarantees that the lender is going to be paid the amount of the remaining mortgage if the buyer defaults. And this is really because of equity. So a lot of times when you first purchase a home, you know, your purchase price, and we talked about appraisals, your purchase price and the value of the home and what it's worth, you're not going to have a whole lot of equity in the home at the beginning of the loan because you haven't been paying on it over the course of the loan yet because it's new, right? So if you don't have 20% down to put down on that purchase at that time, then you don't have a lot of equity in the home. And so if the market kind of shifts or whatever, and things kind of, or maybe you default on your loans and you don't make payments, or you're behind on payments, then the lender's not recouping the initial contract amount, so they're losing money in that sense.
So all this talk about mortgages, and we haven't discussed the loans yet. We're just going to kind of skim over the loans because there are a ton of different loans out there. And hopefully if you're working with a financial counselor or you're working with a credit union or a bank, they will go over the ones that are available and find the one that's best for you, because just because they're out there and you qualify doesn't mean it's the best choice for you. The conventional loans are mortgage loans provided to people who meet certain criteria, including income level, their debt to income ratio, and credit scores. And so those are usually provided by financial institutions, credit unions, and mortgage companies. And then there's non-conventional loans that are government loans that are available to buyers who might not have as great a credit or not have as much money down. There's FHA, there's VA, and there's the USDA. And those are all loans that hopefully if you go to a reputable mortgage company, they're going to talk with you and find the one that's perfect for you.
And I want to add too, there's a lot of great resources online. If you want to learn more about what is an FHA loan, you can actually type that right into Google and learn. I'll just give you some warnings though. Be careful what you're reading online, because most of the ads or the responses that pop up at the top are paid advertising from big companies or finance companies. Sometimes they're even those subprime lenders that we taught about last week.
Good point.
So be careful where you're reading that from. Maybe just go to a source like, a reputable federal, government type site that at least explains what it is. But then once you determine which one you think might be a good fit for you, maybe that's when you want to start talking specifically with your financial institution about the types of loans that they have and if you would qualify for them.
Very good.
And I know from my own personal experience, one thing that I learned was I've read up, this is what we do for a living, right? So I thought I was pretty savvy on the different types of mortgages. And so when I called, I said, this is the type of mortgage that I want, and and had all my ducks in a row. And then about a week into it, they said, well, why did you pick that one? Because this one would be better for you. And they were right. So if you go to somebody that's what they do for a living and they're reputable, go to your credit union, talk with them. They'll steer you in the right direction because they want you to succeed just like you want to succeed. So learn and get the knowledge of the different types, but then be willing to be open to suggestions from your credit union or your bank or the mortgage company. And here's the free resources that Kelly was just talking about. They're out there. The information is wonderful. It's out there for a reason because mortgages are it gets so overwhelming and so confusing. So use these, the Truth in Lending Act, the Consumer Financial Protection Bureau, the U.S. Department of Housing and Urban Development website is amazing, and the USA government or .gov finding a home site. We also have our online resources. If you go out to envisioncu.com/MoneyWise, there's playlists that you can go through, and there's probably 3 or 4 that I went through on home ownership and considering home ownership, and there's a lot of relevant questions out there. Just things to think about. You can watch this video again. It'll be out there on the Facebook, and reach out to somebody, ask questions. Don't make an uneducated decision about something that is the biggest purchase of your life. That's all I can say about that. So, Kelly?
Well, and I just wanted to add real quick, if we have some time here, my advice would be, don't go fall in love with a house and then start all the other planning part. Kelly, thank you so much for bringing this topic to everyone's screens. I hope that those of you who tuned in, that you really learned something new today. As Herschel said, if you have any questions, reach out to us. You can email us directly at community@envisioncu.com, and we'll take your questions there and help point you in the right direction. We're out of time, so we need to run. I know you guys got to get on with your life. And I think Herschel's got a chicken sandwich calling his name.
Yes, I am.
Advertisement, but he does have a favorite. So, all right, guys, we will see you guys later. Thanks so much. See you next week.
See you next week.